Hello everyone. Today I will discuss about interest rate. First of all, we need to know about the meaning of the interest rate. The interest rate is a proportion of the principal, the amount borrowed that a lender charges a borrower. The annual percentage rate is the term used to describe the interest rate on loan. An interest rate can also be applied to the money earned via a saving account or a certificate of deposit at bank or credit union. The income generated on this deposit account is referred to as the annual percentage yield. What is annual percentage rate? It refers to the yearly interest generated by a sum that charged to borrower or paid to investor, expressed as a percentage that represents the actual yearly cost of funds over the term of a loan or income earned on an investment. This includes any fee or additional costs associated with the transaction, but it does not take compounding into account. What is annual percentage yield? It is the real rate of return on an investment after compounding interest taken into account. Compounding interest, unlike simple interest, is calculated on regular basis and the amount is immediately added to the balance. As the account balance grows larger with each passing period, the amount of interest paid on the balance grows as well. What the difference between annual percentage rate and annual percentage yield? First, consumer loan interest rates are usually expressed an annual percentage rate. Lenders expect this rate of return in exchange for the ability to borrow money. Credit card interest rate, for example, the annual percentage rate compound interest for the year is not taken into account by the annual percentage rate. Second, the annual percentage yield is the interest rate earned on a saving account or CD at a bank or credit union. Understanding more about interest rate, how it works. The interest rate on a loan is applied to the principal which the amount borrowed. The interest rate is the borrower of debt as well as the lender rate of return. Because lenders seek compensation for the loss of use of the money during the loan time, the amount to be repaid is frequently greater than the amount borrowed. Instead of granting a loan, the lender may have invested the fund over that time period, generating income from the asset. The interest charge is the difference between the total repayment amount and the original loan amount. Second, interest is a fee levied on a borrower for the use of asset. Third, the majority of loan and borrowing transactions are subject to interest rate. Lastly, when a lender considers a borrower to borrow risk, the lender will normally charge a lower interest rate and vice versa. How are interest rates determined? It determined by a variety of factors, including the status of the economy. The central bank of a country in Indonesia, like the Bank Negara, set interest rate, and bank used to establish the annual percentage range they provide. The cost of debt rise when the central bank set interest rate at a high level. When debt costs are high, people are less likely to borrow, which lower consumer demand. Interest rates also tend to climb in tandem with inflation. Second, to prevent inflation, banks may impose higher reserve requirements, tighten the money supply, and increase credit demand. In a high interest rate economy, people prefer to save their money since the saving rate is higher. The stock market suffers because investors would rather save and earn a greater rate than invest in the stock market, which pay a lower rate. Businesses also have limited access to debt-based capital, resulting in economic contraction. Because borrowers have access to low-interest loans, economies are generally superior during periods of a low interest rate. Because saving rates are low, firms and individuals are more likely to spend and invest in riskier assets such as stocks. Lastly, the expenditure stimulates the economy and inject funds into the capital market, resulting in economic growth. While government favor lower interest rates, they eventually lead to market disequilibrium. in which demand outstrips supply, resulting in inflation. Interest rate rise when inflation occurs, which may be related to Walras law. What the difference between nominal rate and real interest rate? First, the real interest rate not same the nominal rate because it takes inflation into account. The equation that connects nominal rate and real interest rate is nominal rate equals real interest rate plus inflation rate, or nominal rate minus inflation rate equal to real interest rate. Third, investors prioritize the real interest rate rather than nominal rate to minimize purchasing power depletion with inflation. Observing the interest rate on treasury inflation-protected security is one technique to assess the real rate of return in the United States. The difference between a treasury bond yield and the yield on tips of the same maturity provides an estimate of the economic inflation expectation. For example, if the nominal interest rate on a 3-year deposit is 4% and the inflation rate is 3% over that time period, the investor real rate of return is 1%. In contrast, if the nominal interest rate is 2% and yearly inflation is 3%, the investor purchasing power erodes by 1% every year.
Only that for today. Thank you for watching.